This channel reveals the hidden psychology of money, wealth, and modern finance.
You check your banking app. The number looks healthy. Maybe not rich, but stable. Safe. A quiet little digital wall between you and chaos. And that feeling matters. Because for most people, the bank account is more than money. It's reassurance, control, proof that things are okay. But here's the uncomfortable part. The number in your bank feels safe until inflation quietly steals it. Not dramatically. Not all at once. No alarms, no suspicious transactions, no hacker in a hoodie draining your account at 2 a.m. Your money just slowly loses the ability to buy the life it used to. And the strangest part? The number itself barely changes. That's the trick. Because your bank account doesn't measure wealth. It measures currency. And those are not the same thing. 100 years ago, if you buried cash underground and dug it back up decades later, you still had cash. Today, you have a history lesson. Let's say someone in the year 2000 put $10,000 into a savings account and barely touched it. Sounds responsible. Safe. Adult. But over the next 2 decades, something invisible started eating away at it. Inflation. Not because the bank was evil. Not because the account was hacked. But because modern money is designed to slowly lose value over time. In simple terms, every year, your money buys slightly less stuff than it did before. A coffee gets more expensive. Rent climbs. Insurance rises. Groceries quietly mutate into luxury items. And eventually you wake up one morning and realize your salary increased. Your bank balance increased. And somehow you still feel poorer. That's because inflation doesn't destroy numbers. It destroys purchasing power. And purchasing power is what actually matters.
Imagine waking up tomorrow and discovering your height is now measured in different units. Congratulations! You're suddenly 200 tall. Sounds impressive. Except doors also changed size. Beds changed size. Everything adjusted. That's inflation. Your number changes. Reality adjusts faster. Now, here's where things get weird. Most people think keeping money in the bank is financially responsible. And to be fair, for emergencies, stability, and short-term spending, it absolutely is. But long-term, cash behaves almost like a melting ice cube. Slowly, quietly, constantly. Especially in modern economies. Because inflation isn't an accident. Central banks around the world actually target inflation intentionally, usually around 2%. Not zero, not negative, positive. That means the system itself is designed so that your money gradually becomes less valuable over time. Why? Because economies built on spending hate stillness. If money kept gaining value while sitting safely in a bank account, people would stop investing, stop borrowing, stop spending. Economic activity slows. So modern systems quietly encourage the opposite behavior. Spend now. Invest now. Move money now. Because tomorrow, cash will probably...
Real value. Nominal value is the number you see. Real value is what that number can actually do. Humans are surprisingly easy to comfort with stable-looking numbers, which is why inflation feels psychologically invisible. If your employer cut your salary by 7%, you'd panic. You'd probably update your resume before lunch. But if inflation quietly reduces your purchasing power by 7% while your salary stays the same, it somehow feels less offensive. Even though economically, the effect can be similar. The system understands this very well. And this is where the bank account starts behaving almost like theater. Because the interface gives the impression of permanence. The number sits there calmly, clean, stable, comforting. Meanwhile, the economy outside is changing constantly. Housing prices move, asset prices move, energy prices move, healthcare moves. Your money stays still. And in inflationary environments, stillness is expensive. Now, to be clear, this does not mean banks are useless. That would be ridiculous. Banks solve real problems: security, liquidity, payments, access to credit. The issue is psychological. People mistake stored cash for stored wealth, and they are not identical. Real wealth usually lives in assets, things that can adapt with inflation. Businesses, real estate, productive investments.
Ownership. That's why wealthy people often keep surprisingly little of their net worth sitting in cash long term. Because they understand something critical. Cash is stable in appearance, but unstable in purchasing power. Assets are unstable in appearance, but often more resilient over time. That's the irony. The thing that looks risky can sometimes preserve value better than the thing that looks safe. And history keeps repeating this lesson, over and over. In the 1970s, inflation surged so aggressively that ordinary savings lost value rapidly. In countries experiencing extreme inflation, entire lifetimes of savings have effectively evaporated. Middle classes shrank almost overnight. Not because money disappeared physically, but because the currency itself stopped representing meaningful value.